Good morning, everybody. Happy Friday. My name is Gareth Soloway, Chief Market Strategist here at verifiedinvesting.com. This is the game plan, and we are going to get into the technical analysis and the data analysis today with trade levels for the charts. All right. So, first and foremost, PPI data came out this morning. It was much better than expected. Now, that means lower inflation. Now, we all cheer lower inflation, but the problem is, lower inflation is also tied to recessions and depressions. So we're watching very closely. The markets initially upticked on this news because, again, lower inflation gives the Federal Reserve the ability to maneuver and maybe cut rates. But at the same time, it kind of backed off and the market came back in because we know that these latest rounds of tariffs, all the tariffs on China, for instance, they are not in this data. So that is something that the markets are kind of, in a weird way, ignoring Wednesday's or Thursday's CPI number, which was yesterday, and the PPI data today. Now let's flip over to the charts and take a look at a few things. This is the S&P futures. By the way, you'll see a ticker at the bottom. I put the key headlines here on the day in there, the things that I am watching, the data points as well. Those will go through across the board in the bottom. All right, so this is the S&P futures chart. This was yesterday's fall on the markets, right? So early in the day, we had this big fall. The markets rebounded a little bit into the end of the day. Overnight, we dipped, we rallied, we dipped, and now we're chopping. What does this look like to you guys on a technical analysis basis? I'm going to show you. And by the way, this is the futures, so this shows us all overnight data. Every uptick, every downtick in the markets in the overnight. Now, if we look at this, take a look at this, guys. This is so cool. Look at how even overnight, there's a trend line right here, right? So look at this. Low pivot, low pivot, low pivot, and then kisses here and here. Look at this. Take this and draw this down here. And we basically have what's called a wedge pattern in technical analysis. Okay, so that's number one. All right, that is the key here. So what we're looking for into the open is, do we get a breakout above here, which on the futures, on the S&P futures would be above 53.50 or so, or do we get a breakdown below 5,300? If we get a breakdown, we could head to this pivot at 52.60. This would be first support, second support, and obviously third support double bottom. If we break out to the upside, we have resistance here, and then subsequent resistance up in this range. So again, the beauty of wedge patterns, and remember what wedge patterns are, folks, right? Wedge patterns are consolidation periods where you basically have a big move and then inside of that smaller and smaller moves, which is why you can connect the highs and the lows and it creates a tightening wedge. Okay, so that's something we want to be very clear and watching here. All right, so again, keep an eye on that for which way does it break out. Does it break to the upside? Does it break to the downside? All right, going to some other charts here. Let's take a look. Let's flip back to the daily. Bear with me as I erase these trend lines. So when we go to our daily chart, we can see the beauty and the key trend lines on the daily time frame. So obviously this was a level that I highlighted to you guys was major support. We saw that epic bounce on Wednesday off of it, although we did retrace a chunk of it on Thursday. Notice again, your bull market high from 2021, your bear market lows from COVID 2022, and then right through here in 2023. And those levels gave us our short-term low. Notice the mega rally we saw on Wednesday. Where did it take us? To this pivot low, which isn't a big level, but it is a resistance level, right? You could clearly see a pivot, right? Pivots, remember, it's a sharp move down and then a move up. That creates a pivot low. So here you can see that right there, perfectly a resistance level. Now, if we can break through this level to the upside and continue to rally, what do we have? We have resistance at gap fill on the S&P here around 5,700. All right, so that's in the S&P futures, but essentially equates with the S&P overall. All right, so that again is your next resistance. To the downside in terms of support, what do we have? We basically just have the major level right here again. That would be your major support. So major resistance 1, major resistance 2, and support number 1. At this point, I'm not going to go over support number 2 because we're still pretty far away from that level on the charts. Okay, now flipping over to the NASDAQ 100 here, the NASDAQ 100 retraced after that epic move to the upside. Same thing applies. You have resistance at this gap fill, followed by pivot high resistance here on the QQQ, and then downside support right in this range. Now, you can see it on the bottom of my screen as the ticker rolls through. This is the most important thing. Look at what's going on here, guys. We are seeing a rally back up on the 10-year yield. Now, this is very, very important. So again, taking a look, or I should say on Wednesday, remember the big rally we had in the stock market? The rally was kicked off and yields were trading sharply higher. As President Trump made the announcement on tariffs that it was going to be delayed on most countries except for China, yields fell. That enabled the markets to rally higher. Now, yesterday, the yields rallied back. Markets went down. Today, yields are starting to push back up here. And this, again, my friends, is the deciding factor. Now, this is something I'm going to reveal to you guys. So do not think that China was not watching very, very, very closely when Donald Trump pulled the tariffs back in partial on all countries but China. And why did he do that? And if you've been tuning into the game plan, you know why. Because the bond market forced him to. Yields began to spike, although normally in a down market, yields would go down because the treasuries are generally a go-to safety play. And that means if there's more demand for treasuries, yields go lower. In this case, as the markets were collapsing, yields were going up. Now, China's looking at this, and I'm telling you exactly, right? So China's saying, wait a minute. So he blinked because yields, the bond market forced him to. Because remember, the U.S. has like $7 trillion in debt they have to refinance this year. I mean, it's incredible, right? And we're obviously doing bond auctions all the time. And interest rates play a role on borrowing money in our economy and in mortgage rates and all of this. So, I mean, literally, it's the foot on the throat of the United States is what the interest rate is. And so China owns a ton of treasuries, and they are now seeing that Donald Trump will blink if the yields go up. Now, listen, I don't have any proof of this, but don't think that they're not smart enough to say, wow, if we dump X amount of treasuries and we push the yield to 5% or 4.75%, maybe Trump will come to us and try to make a deal to then have the stock market rally again, right? Or yields come back in. And so these are the things, at least in my mind, that I'm constantly analyzing as a technician, looking at charts and data to try to figure out. So these are things, again, we have to watch. And look, yields are pushing up. We're even going higher right now, guys. Look at this. Look at this pop on the 10-minute chart of the 10-year yield. We're all the way back now to 4.5%. Now look at this. If we look at the 10, and look at this, see the markets are starting to come in. This is the ES futures again. Now listen, we're still net positive, but if this continues, the SI, what I mean is the S&P is still flat to positive. We're still hanging on to small gains today. But if we don't see yields pause or start to pull back, we're going to likely see the stock market begin to roll over. And this, again, this chart, the 10-year yield, which is now back to 4.5%, not good for mortgages, the housing market, borrowing money, all of those things, and including the U.S. debt that has to be basically refinanced. If this keeps going up, that's going to be problematic, and we will see new lows on the S&P. All right, so that's something I want you guys watching. In addition, if we flip over to the DXY, look at the breakdown on the DXY. This is the dollar, folks. So if you don't know, the DXY is the dollar index. This is not good. Why? Because generally, the dollar is looked at as a safe haven asset, just like treasuries. When there's panic in the global picture, people generally and other countries buy U.S. dollars. Clearly, they are not doing that. The dollar is down basically at lows not seen now since, wow, how far do we have to go back here? We have to go back to 2022, all the way back here. And we've broken this trend line here, which likely means further downside, probably down on the Dixie to about, and by the way, that's the shortened term for DXY is Dixie, is down to the 97 or just below on the DXY chart here. All right, so again, there's a dislocation. A lot of people a couple years ago with crypto, they were all, oh, the dollar's done, the dollar, de-dollarization, we heard about that. Well, you know what? These tariffs, putting the screws to the rest of the world, to China, that's going to push other countries to say, wait a minute, we can't have the U.S. having so much control over us. We actually do need to figure out a way to de-dollarize, right, to get away from the U.S. dollar. Now, is this good for gold? Heck yeah. You look at gold. Gold is soaring again today. Is this good for Bitcoin? Longer term, yeah, frankly, it is. It's an alternative to the US dollar. Absolutely. And we'll look at that chart in just a little bit. All right, flipping over to earnings. JP Morgan reported earnings this morning right here. This is the pre-market data on the 10-minute chart. This is a pop on earnings, and then look, it's rolling over here. Now, is it rolling over because the earnings were bad? No, not really. It's rolling over because yields are going higher. That's not good for the economy. And it's also just kind of saying, listen, JP Morgan is still relatively highly valued. So even though the bank earnings overall were very, very good, and if we look at Morgan Stanley reported earnings, but look, it's coming down. Now, it's not down a lot, but BlackRock reported earnings. All right, the stock barely moving, inching back down a little bit. Wells Fargo reported earnings. That stock, again, initially popped on earnings here and is now falling back to the wayside and heading lower. And again, the point being is that these companies, especially the CEOs, are sending out warning signals. Why? Well, Jamie Dimon said it today. He said the U.S. economy is in a really bad place right now, in a turbulent zone. And that ultimately is not good for further earnings. Like if you're trying to price in where JP Morgan should be valued in a year, how do you even do that as an analyst or a technician or anything? I mean, basically you have only the charts to go by, which is what I use, which is helpful because it actually tends to be more right than wrong. But if you're someone who uses fundamentals, what are the earnings going to be next year on JPPM? What are they going to be on Wells Fargo? What are they going to be on any of these stocks? We don't know. And by the way, you saw at the bottom of the screen, we had China jacking up tariffs to 125%. The U.S. is tariffing back at 145%. And one of the interesting things that China said was, they said, guys, we're going to stick at 100. Even if the U.S. raises tariffs, there's no point in us raising tariffs anymore on the U.S. goods higher than 125%, because goods are going to be so expensive that no one's going to buy them anyways. And I hate to say that, but that's the same in terms of goods coming over from China. 145% more, like per widget or per shirt or per shoe. I mean, are you really going to go out and spend, like, let's say a pair of Nikes? I don't even know what they cost anymore, like $125, maybe cheap. I don't really know. But the point being, by the way, you can tell I don't really buy Nikes or not into shoes that much. But the point being is that, are you really going to pay, if you're used to paying $125, you're going to pay $300 for that same pair of Nikes? I certainly wouldn't. But again, I'm not a shoe guy then, in all fairness. But I guess that's my point is, how many of us, especially with the economy and inflation going where it is, are going to be paying 145% more for these goods from China? I don't think a lot of people will, personally. All right. So again, the economies between China and the U.S. likely coming to a standstill. Let's take a look at a few of these other charts here. What do we have up here? We have NVIDIA. NVIDIA, again, if we look pre-market, this was up earlier in the day. Look, as yields are going up, it's starting to put pressure on these stocks. Okay, so again, we're starting to see that coming in. Bitcoin, flipping over to Bitcoin. Now, Bitcoin is up a little bit, probably being helped because the dollar continues to go lower. I do think there is a component here of a goldish type digital asset. It's not fully there yet, but it slowly is maneuvering towards that. So again, nice to see Bitcoin up. The question I would have for Bitcoin is, number one, it hasn't broken resistance yet. So that's something you're watching. And number two is, if the stock market really takes a tumble, can Bitcoin withstand the panic of investors that are invested in stocks that are panicking and selling everything? And that's the bigger question there. Let's look quickly at gold. Gold continuing to be a rock star. Look at this, guys. This is a little bit of resistance. I'm curious, by the end of the day, do we kind of come in this range? I did start to nibble in the early session today on a short on gold. So I'll just be honest with you guys with that. That's with commodity members. They got my exact entry, my exact ETF that I'm using on that. But again, I did nibble on a short on gold this morning. And again, I do think we are potentially seeing that next pullback. Remember, I was short over here on gold. I actually covered, thank goodness, right here at technical support with members of the commodity service. And then I've just reopened a short right up in this range on gold today. Silver, I am long some silver with commodity members. So far, so good. We picked it up over here, right in this range, and it has bounced up nicely, and we are continuing to maneuver higher here. This is a short-term target here. I likely will take profits on silver up into that range, as again, I am a swing trader. If we look at oil today, Oil is inching back down. Remember, any sort of struggle here in the economy or higher tariffs or whatever it may be, it's going to put pressure on something that is so intricate to the global economy. Remember, China is the biggest importer of oil, and the tariffs from the U.S. are going to slow their economy, right? Their economy was already slow. It's going to slow it even more. And so really, where is oil going to go? I mean, unless something happens where, I mean, listen, if a deal is struck with the Trump administration and the Chinese, well, then, yeah, oil should bounce. But until then, it's going to slow the economy. All right, next up, let's take a look at natural gas real quick here and see what we have on that front. Nat gas today is flattish on the day, not a whole lot going on there. So, again, flipping back to the ES, look at this, guys. It continues to go down, and we know why, right? We simply know why. The 10-year yield. This is putting pressure. So if you want to watch one chart today, watch the 10-year yield. And it would help if I could type it in correctly here on the charts. Look at this run on the 10-year yield. Now it's pulling back a little bit. See this pullback? If we flip back to the ES, look at how the ES is getting a little bounce here. So you can see the correlation or inverse correlation of these two charts. But I just want to reiterate that legit, the 10-year yield and the bond market is the factor to watch. And the Chinese are fully aware of that, as is the rest of the world. And if you're going to put the screws to the U.S., that's what you have to do. Okay, the U.S. doesn't import enough from, well, China, yes, but the key is the bond market. The bond market is the megalith. That's the Megatron of the financial world. And if that gets nasty, if that gets crazy, that's going to be what's going to push the hand of the government of Trump to potentially make a deal. All right, guys, I got to get to my trading room. It's been an amazing few weeks of day trading and swing trading. Let's see if it continues today into next week. Thank you guys again from the bottom of my heart for supporting us here at Verified Investing, of looking at charts more on a technical basis with the data versus the hype and this and that. It's so much nonsense out there. Mainstream media narratives, social media hype. I really want to be the place where you guys come for the facts, not the nonsense. And I thank you all for your support. Have a great, great weekend, guys. Actually, I'll do a weekday update today at the end of the day, going into the weekend. But either way, have a great weekend if I don't talk to you till then. Take care.